Hey there, Ryan here from Precision Trading Labs with about to bring you a really important training. I kind of find most traders focus on just one way to trade, but if you could maximize your returns by picking the best instrument for each setup, I think you'd actually get a better ROI. Okay, so here's what I mean. Today I'm going to or excuse me, I have to say me and Mitch, and really Mitch does most of the heavy lifting in this training. So kudos to him for just taking the reins. And we got asked by a student. His name is Edwin in our program, who's really working his butt off to try and get off the ground, and he's been with us just about a month. Wait, that's February, so 2 months. And put in the work to get good at this. And he asked a great question in our last session, which was, what's more profitable, stocks, options, futures? There's more to it than that. So today what we're going to do is we're going to break down how to express the same trade using a stock, an option, or a futures contracts, so you can trade smarter, not harder. So what I'd love you to do is hang out. I'm going to turn things over to Mitch in 1 second. But before I do, if you wind up getting some value from this training, it would be great if you could like and share this training with people that would find it valuable. And then if you want to get some more information on how you can work with us and attend these sessions live and get coaching from us, go ahead, click the link in the description. In there we'll have areas for free material, my booking link if you want to do a private Zoom call, all that good stuff. So go ahead, enjoy this video, stay to the end, and Mitch is going to go through some of the student questions and all that kind of good stuff. And go ahead, if you really get some good value of this video, would love if you would hit the like button, and that way you get know about more videos we put out. Anyway, let me turn things over to Mitch Firestone, my business partner here. Is going to go through the differences and the pros and cons and all the cool stuff with stocks, futures, and options. Thanks. 2 minutes. Let me know. I'll do another instrument.
No, it's fine. Hang on. Okay, you got my screen there?
Got it.
All right.
Mute myself.
So one of the things, and I don't know if it was a friend, Edwin, I can't remember who had asked the other day about kind of like the different instruments, okay, or the different asset classes. So of course we have essentially there are three core asset classes. There's foreign exchange, the equity markets, and futures. Those are the core asset classes because they are like asset classes unto themselves. Then you have the derivative asset class, which is options. And of course, options can be tied to either equities, stocks, and ETFs, or they can also be tied to futures. I've never actually traded those. So what I was going to do here today was to look at a couple of different instruments. In other words, a couple of different charts, and then we're going to talk about the concept of expressing a trade. Okay. And so in terms of that, what we mean by expressing a trade is, let's just say once you're looking at a chart of, let's say, of the SPY, okay, which is of course the ETF of the S&P 500, okay, this is a chart of the SPY, okay, and so right here, and also I mapped out some zones for the purpose of this presentation here. They aren't necessarily the greatest zones. I was just simply trying to find something that looked reasonable and also that the chart had a lot of space in it so I could kind of do some annotations and also match it up with a couple of other asset classes. So we have a rally-based rally here on the SPY. You might look over here and go, well, I don't know, is that really a fresh level? And the answer is it probably isn't. But I did this here mostly just for the purpose of a presentation here, okay? So don't get too hung up on that. You'll actually see though on the second example I actually did something on oil, and that one actually is a pretty good zone. So I wouldn't be racing to short this one here. But anyway, in terms of expressing a trade, okay, this is the SPY, the ETF of the S&P 500. And so there were essentially three ones could express a trade. Okay. One could short the SPY. Okay. That's the most direct route. Okay. The second way would be to buy options on the SPY. And of course, the most direct route on that, in the case of a supply zone, of course, would be to buy a put. Okay, and to bet on a bearish move out of that supply zone. Okay, so one could buy a put And then, of course, within the options world, then there are numerous other ways you could express a trade. You could sell a credit spread by essentially basically selling a call, let's say around here, okay? And then you would buy a call further up, and then you wouldn't have a naked call. But at that point, then you'd be able to collect premium, again, based on the supposition that the supply zone is going to push price down. Those are all different ways of expressing a trade off of the same chart formation. And then the last way one could express a trade is, in many cases, the chart of an equity will often match up with a chart of its analogous futures instrument. Uh, sometimes it does, sometimes it doesn't, because of the fact that the futures, of course, trade 24, close to 24 hours. And of course, the equity market in the U.S. only trades for 6.5, and that's certainly the only time that we care about. There is the before, the pre-market, and the post-market, but I'm not a fan of that in terms of creating levels here. So at any rate, those are all ways of expressing a trade. And in the case of the futures, you could, of course, short the futures. Okay. So, and then the futures trade would look something like that. So you just saw the supply zone on the SPY. Okay. Here would be the supply zone on the ES or the MES, which is the micro S&P futures. And you can see that there's that same exact zone there. And of course, I got that same exact comment before. I don't necessarily know if I would be racing to short out of here, again, because of the fact that we're dealing with, this is not a fresh level. Okay. But again, for the purpose of conversation, we're going to look at this. All right. So what we're going to do is we're going to compare how do we express a trade here using the three instruments: shorting the SPY, shorting the S&P futures, whether it's through the ES or the MES, and then also buying a put. And we're going to compare all three of them. Okay, but essentially they're all predicated on finding a zone, and then basically that's where your entry point and your trigger is going to be. Okay, so we're gonna break this down. All right, so that's the game plan here, and we're going to do that for both the S&P, and then we're going to also do the analogous thing for oil. All right, so let's start out with the SPY here. Okay, so when one wants to think about trading an instrument and what does it entail? Let me just get this out of here for a second. There's basically a number of elements here. Okay, so in no particular order, or actually, in fact, let's go in the particular order. The first thing you need to know, of course, is can you essentially afford to trade it? In other words, how much buying power does it require in terms, let's just say you have an account. Anytime you're going to put in an order, your broker is essentially going to cleave off the amount of money that's required to actually get into the order that you're looking to do at the particular price and in the particular quantity that you specified. Okay, so in terms of trading the SPY itself, okay, obviously it's a very, very costly instrument. Okay, at this point it's about 610. It's coming up again back to that level of close to $610 a share. Okay, so if you were going to trade 100 shares of the SPY, okay, you would literally need to have $60,900 in your account in order to cover 100 shares of that. Okay. Now, also as an aside, and we're not going to go into this today or consider this today, but as we know, different brokers have different policies with respect to offering margin. If you're doing a prop account, they oftentimes offer, great multiple margin, multiples of margin. So we're not going to get into any of that here. We're just going to simply stick to what is the value of this, what is the value of the share, and whatever the value of the share or the instrument is, that's how much you have to put up. Okay, so in the case of the SPY, again, you would have to put up essentially close to, call it really $61,000 at the 610 level. Okay, so that's the buying power that it entails. Okay, and also what we're going to do when we go to the other charts is in order to try to compare apples to apples, um, we're going to kind of stick to looking at how much money one has to put up, and then also how much risk there is in the trade. And to the degree that I could, I kind of tried to keep those in the same ballpark so that more or less we're comparing apples to apples here. All right. So in terms of shorting the SPY, again, you would need about $60,900. Okay, at that level of 609. Okay, so that's what's required in terms of your buying power. Okay, so now looking at the zone goes from 609 to 610.50. You can see that essentially the zone is about $1 deep. Okay, then I went up here. I looked at my daily average true range. We can see that for the last 14 days, this thing has moved on average of a little less than $7 a day, 675. So 10% of that would be 67 cents. And looking at this, since this is about $1 deep, I said, well, all right, I'll give it some wiggle room. And it just seems like reasonable to kind of give it about 50 cents. You could give it a quarter, you could give it 50, but looking right back here, I saw where this wick went up here, and that wick went to about 610.34. So then I gave about an extra 15 cents on top of that for good luck. All right. So, and you can see right there, there's actually I believe that's your all-time high there. In fact, if I was smart, I would probably even probably give this even a little more wiggle room if I was going to take this trade. Just because of the fact that oftentimes things will test the all-time high. But again, for the purpose of this, and particularly because I already mapped this out, we're just going to leave it the way it is here. All right. So that's what this trade would entail. So this trade would entail $150 of risk, $1.50 a share times 100 shares, and we're going to, like I said, we're going to try to go apples to apples here. So 100 shares would entail a $150 risk. Okay. If you compare that $150 risk to how much money you actually have to put up in the trade, it's a pretty small amount, right? Obviously, it's 150 divided by $61,000. And essentially that comes out to 0.25%. Okay. So 1/4 of 1% is what your risk would be in terms of looking at sort of like on a return on investment. If you consider that your investment was going to be 60,900 to put into this trade, well then obviously your ROR, okay, if you lost on this, would be minus. In fact, I should throw a minus sign in here. That would be minus 0.25%. On the other hand, if things go according to plan, and you hit your supply zone, and then you get that drop down to 3-to-1, well then obviously 3-to-1, of course, you would be up 0.75%, and that would be $450. Okay, so that's what this trade looks like if you short the SPY. Okay, if things don't go right, you lose $150. If things go right, excuse me, if things go wrong, you lose 150. If things go right, you make 450. And then that's what it represents in terms of your so-called investment into the trade, 0.25% versus 0.75%. Okay, so that's what this trade looks like if you if you trade the stock. Okay, so now the question is, and let me just get this other thing here. What if in fact you trade the option? Okay, so here's what the option trade would look like. Okay, so you guys have seen this before. Okay, and let me just shrink this down so we can see where all of our key price slices and all that stuff are. Hang on one second, let me just slide that over. Okay, so you've seen this before. So here is the SPY. Okay, and since we're sitting at that 609 level, okay, we would be looking to oh, well, hang on. I'm sorry, hang on one second. Brought up the wrong one here. Let's try that one more time. There we go. So if we were going to short the SPY, okay, we would be buying the 610 put. Okay, so there's our 610 put. Okay, we would buy the April 7th, the one that expires April 17th. Okay, that's going to be expiring in 63 days. So let's just say it takes, a day or two to get up here. We would probably, with any luck, stay above that 50-day till expiration to go. So we're not getting too beaten up by time decay. So, we've talked about that before. And so here's what the trade would look like. Okay. If in fact we get in at that 609 mark, okay, I put in these price slices here. So at the time that I took this snapshot, um, the option was selling at 1410. I took this snapshot about an hour or so ago, or right near the open. So the option itself was selling at 1410. Of course, we would not be buying this at 1410 because we're waiting for it to pull back to 609. So we're looking for about a $4.50 move up from 604.50 up to 609. When it does that, okay, at that point, then this option is now going to its premium is going to erode by about what is that by about $2. And then that would bring it back to close to about $12. So that's what this option would sell for, literally $11.95 according to the pricing model. Okay, and how the platform computes it. All right. So at that point, then we create that as a 0 point for the trade. Okay. So if we get stopped out relatively quickly, okay, we would lose approximately $65 going from 609 up to that 610.50 mark. Okay. Okay, this thing is running about a delta of about 44. The SPY is a relatively calm instrument with respect to delta. So even though we're a bit in the money, you can see we're actually running a delta of under 50. And there's a reason for that. I'm not going to go into the whole deal now, because it is one normally expects to see a delta of roughly about 50 when you're at the money. So I'm not going to go into this now. But anyway, the point is that's what the trade looks like. Okay, so you lose about 65 cents if it happens relatively quickly. On the other hand, if you, let's say you got down to 606, okay, then you would make about a buck 40, okay, and the value of the option would go up from about $12 to about 13.40. So there's your buck 40, okay. And if you made it to target 3 at 604.50, then this option then gets up to about $14 a share, $14 a contract, and then which of course means the contract is worth $1,400. And then at that point, then your profit would be a little over 200. Okay, so that's what your trade looks like. 65. If it happens quickly, a $65 loss, and then either a 140 or a 215 win. Okay, so if we go back to this now, and we now compare the option. Okay, the buying power to get into this option trade. Okay, we recall we required about 61 grand to get into to short the SPY. Okay, in order to buy one contract. Oh, I might be getting into a British pound trade soon. Since we looked at this on the perspective of 100 shares, we're going to look at this from the perspective of one contract, because one contract, of course, controls 100 shares. So there's your apples to apples idea here. So if that occurs, then for the British pound, the buying power required is going to be that 11.95 that we just looked at in the options platform. Okay. So then the risk, okay, is that $65 that I just showed you in the slide there. And then I also built in, okay, if you recall, I said, well, that's what would happen if we lost quickly. Okay. But what if in fact it takes us a week or two to lose? Okay. Well, then, as we know, when it comes to buying puts and calls, you almost if things don't go right, hey, if does somebody have something going in the background there?
I'll check.
Is that Doug? Maybe.
I got it. I got it.
Thank you.
Yes.
This is almost like ripping off a Band-Aid. You would much rather just lose quickly if you're going to lose, okay? Because as we know, time is money. But nonetheless, you trade the market you're given, not the market you want. And so it could take a while. So if it took a while for you to lose on this trade, then in fact you kind of have to do either a seat of the pants estimate or actually utilize the options platform to kind of help you and say, okay, if it took, let's say, 10 days to lose, how much am I going to lose? Or if I'm in the trade for 2 weeks. So I just quickly just kind of just threw in an extra 35 bucks on top. I didn't do any great analysis. So in theory, if it took you a couple of weeks, maybe you'd lose another 35 bucks on top of that. Here's where I set it up and said, okay, we're going to lose anywhere from 65 to 100 bucks on this trade if things don't go well, depending on how long it takes. Okay. At that point, then, okay, based on your investment, which is that 1195, that's how much money you had to put into the trade or to set aside for the trade. Well, that loss would represent approximately a 5.5% loss at the bottom of the range to about an 8.5% loss at the top of the range. Okay. So if you compare now, obviously the percentages involved, obviously they are huge as compared to the underlying instrument in terms of with respect to the option. Okay. On the other hand, of course, you're putting up a mere fraction. This is about 1,000. This is about 61,000. This is about 1.5% or so of that number. Okay, so you're putting up 1.5% of in terms of the buying power required versus the stock. Obviously now because of that, the actual risk, the return on investment, as well as the loss on investment, are actually, of course, going to be much bigger. Okay, but in terms of the absolute numbers, again, that's 1.5% of that. Okay, so that's how the losses compare. Okay. Now, if we go to if things go right for you, okay, and let's just say let's say you get to your 3 to 1, okay, and of course your 3 to 1 would look like, at this point you can see, and to some degree 3 to 1 kind of makes sense, right there. There's a little area of demand that formed there, and so if in fact, if price did start to head down, it's totally reasonable to say, okay, I could get my 3 to 1 there because that's the first place where you might expect price to stop, assuming that the market kind of cooperates there. So there's your 3 to 1 on your stock. Okay. So if you're risking 150, you're 3 to 1, of course, going from 609 to 604 50. That's a $4.50 gain. So that's 450 bucks. There's your 3 to 1. And in terms of your return on investment, again, based on that 60,900, that's 0.75% for the stock. Okay. Now, if we go back to the option, okay. So looking at the option, again, I showed you this in the slide. Okay, so right there, there's your 3 to 1 there. There's that 215. Excuse me, that's 604.50. There's that 214, 215 number that I showed you before. Okay, and then I did the same exact thing here by basically saying, okay, that's what happens if it happens quickly. Well, what if it takes 2 weeks for you to make that money? Well, then at that point, things are going to change because at that point, then we're going to, again, time decay is going to come into play. And again, I just kind of winged it here. And in fact, I probably should just be consistent. I think I took 30 off on top, 35 off on top. So we'll take off 35 here. So that would be 180. You would basically make 180, and then that 180 based on the 1195, that would be 15.1%. Okay, so that's what your return on investment would look like in terms of. So that's what your return on investment would look like with respect to how much you had to put in. Okay, you put in about 1,200 bucks, and you'd expect to make about $1.80 to $2.15, and again, that represents roughly about 15 to 18%. Okay, so you can see now comparing the stock to the put. Okay, that's how all of this kind of shakes out in comparison. All right, so that kind of gives you the comparison between the equity and then the derivative of the equity, which is the put. All right, so now let's take a look at the expressing the trade using the S&P futures. And if you notice, we were looking at a daily chart, I think, on the SPY. I broke this down and utilized a 2-hour chart for the MES and the ES futures there. So again, there's that level that we just talked about there. So here's how this other stuff shakes out. If we were going to short the futures instrument, okay. In fact, let me just throw in here. Hang on 1 second here. Let me just throw in. Hang on 1 second. Hang on. Let me just grab those other numbers here so we can compare everything. Should have done this before. I was working on the oil one, and I knew I'd forgotten to do one thing. Hang on. Let me just grab this here. Okay. So let's take a look now at expressing this trade using the futures. So if we were going to do that, okay, in terms of the amount that you would actually have to put up, okay, there is what's required. I guess they refer to it as margin requirement for the futures as well. Okay, and so the margin for the and this has actually changed over time, because I remember when I first started trading, when Ryan and I first started trading the S&P, and this is like 12 years or so ago, in terms of the full contract. The full contract was basically about $5,000 to $5,500.
Yep.
Okay. The full contract now is $16,000. Okay. So in terms of, and again, we're back to that apples to apples thing. I was looking at this. So if the full contract is 16,000, the micro is going to be 1/10 of that. And so that's $1,600. Okay. And then there's little variations of whether you're going long or going short. Okay. And then I think there's also something called maintenance margin, that if you're going to be holding it overnight, that then there's a different margin for that. So I'm just going to kind of stick to the core thing here, particularly because most of us are doing the Apex program, the funded trader program. And so that limits you to intraday anyway. Okay. So in terms of how this shakes out vis-a-vis this other stuff, okay, the buying power required to execute and to short one MES contract, which is the micro, is $1,600. Okay, and then the risk on that, okay, if we look at how many ticks that we have here, okay, 128 to 152, okay, that's 24 points. Okay. Okay, that's 24 points going from 61.28 to 61.52. Okay, the full contract on the S&P is $50 a point. It's $12.50 a tick. But of course, since we're trading the micros, it's all, we move the decimal point over, it's all 1/10. Okay, so if it's $50 a point for the full contract, it's $5 a point for the micro. Okay, and so for 24 points, going from 28 to 52, then that would bring our risk down then to 120. Okay, so that's how much money we would be risking getting into this trade here, and hopefully not getting stopped out there. But if we did, we would lose $120. Okay, and if we compare that $120 to the 1,600 that we had to put up to get into this trade, essentially think of that as your investment. Well, then your ROI here is going to be minus 0.75%, minus 7.5%. Okay, so that's what that looks like on the downside. And then, of course, on the positive side, if things go well, well, then in fact you would make, of course, if you got to your 3-to-1 here, then you'd make 360, and that would represent 22.5%. All right, so that's your comparison between shorting the stock, buying a put, and then expressing the trade by shorting the S&P futures. And if you notice right here, the stock is kind of in a world unto itself. Okay, the return on investment as well as the loss are minuscule, and the amount of money that's required to the cost of entry is in certain cases big, in certain cases, in this case, gargantuan. Okay. On the other hand, the option offers you great leverage, and obviously far reduced cost of entry. Um, and of course, the one caveat is, there is some complexity to the option as well as uncertainty because of the fact that you've got that time element in it. It's a wasting asset. And as a result, there is, of course, that concept of time decay that you have to keep in mind. And so as a result, it's oftentimes, and then of course, because of how options move, you really only know how much they're worth either on a calculated basis or whether trades are occurring. So there are times that you really don't precisely know what you're going to get when you buy or sell an option, unless of course you put in and of course if you put in a limit order, well then you will get your price. But the point is sometimes you get your price, but you only got your price because the trade moved slightly against you, and then the price of it kind of went a little unfavorable, and then the market making algorithm said, okay, now we're happy to give it to you. So to a degree, the option pricing is a little murky. I love it. It's great. They're awesome. And it's my favorite thing to do. But one acknowledges the pros and the cons of everything. Okay, so there's that. And then lastly, here's the option. Excuse me, the futures. And if you notice the futures, it kind of looks somewhat in the same neighborhood here. You can see right here on the for the buying power required, one's 1600, one's 1200. Okay. Okay, you can see right here the risk on the trade is 120 bucks. Here the risk on the trade is 65 to 100. So you can see these are kind of in the same neighborhood here. And then lastly, here's what the profits look like. And again, you can see right here, the profit, if we got down to here, this was about 23%. Here is about 15 to 18%. Okay. So that's how this all kind of shakes out. Okay. That's how you could express the trade using the three different instruments. And here's what the buying power looks like. Here's how your risk looks like. Here's what your profit looks like, both in absolute figures as well as in terms of thinking about it with respect to return on investment. All right. So that's kind of the story there. One, of course, and of course, obviously, if you're putting up multiple, obviously you take, if you're going to trade multiple contracts, well, then you'd multiply this, by whatever you need to do. But again, just trying to compare the apples to apples element here. I tried to kind of keep things in the same neighborhood so that we could see, kind of how these shake out. So, needless to say, I will share this chart with you and all that. So let me quickly, and I won't go as heavily into detail now that we kind of went through this already, but I'm going to do this one more time for oil. All right, since particularly Ryan was just talking about the CL. So let's take a look at oil here, and we're going to do the same exact thing here. So bear with me 1 second. Let me just get the S&P out of here, and then we'll go to oil. Oops, I think I just got rid of the wrong thing here, right? Did I? Yes, I did. Okay, so let's get rid of the S&P, and then we're going to move on to oil. So in terms of oil, there is the CL contract, okay, and then there is also the. Hang on, let me just get the right chart up here. Okay, there's the CL contract for the futures, and then there is what's referred to as the USO ETF. Okay, that's United States Oil. Okay, and that's the ETF that essentially tracks the price. And I think it's a combination of both West Texas crude and Brent crude. There's the two main types of crude. I think it actually kind of is an amalgam of the two. Okay, so if we go to the chart of USO. Okay, so here's the daily chart of USO, and you can see we've obviously been in a that big down move ever since about what is that mid January or so. We had hit a peak on that of about 84.50, and now we've obviously come down about $10. So that's about a 12% decline here, give or take. So we're actually heading right here to this rally formation here on the daily chart. Okay, so if one was going to be looking at a potential setup here, so one would get in at 74.40. We put the stop at 73.50 here. Okay, so each unit of risk on this would be 90 cents. Okay, so obviously a 3-to-1 trade here, would you'd be making 270 from 74.40 to 77.10. Okay, the buying power to get into this trade would be 74.40. Okay, 74.4 times 100. Okay, so if you, for 100 shares. Okay, then in terms of the risk, okay, again, the risk, of course, would be the 90 cents from entry to stop. And so that's $90 per 100 shares. That $90 per 100 shares represents a little over 1%, 1.2% of what you needed to get into the trade. Okay, so that's what that's what that's essentially your negative return on investment, your loss return, negative return on investment is. Okay, so that's not okay. And then if you hit 3-to-1 on that trade, well, then it's 270. Okay, and that would, of course, would represent a return on investment of based on the 74.40 of 3.6%. Okay, so that's what that would look like. Okay, if you were going to buy a call, okay, well, then here's what the call would look like here. So let's bring that up here. And let's just slide this over again so we can see everything we need to see. Okay, so we would be getting, okay, first of all, we would be buying again the April 17th expiration. Okay, we got 63 days to go. We're sitting right up here now, so we could very easily be in this trade within a, let's say by tomorrow or Monday, if it continues to drop. So we would, basically we would have a good 10 days in the trade before we would sort of be, hinting at that 50 day. The reason I didn't go out further, just as an aside, is for the moment. If we look at the options platform here, you'll notice, whoops, wrong one. If we go to the options platform, you'll see, looking at what the options that are offered here, and you'll find this with options. Um, when you go out certain times, so if you notice right here, okay, here's the April 17th, and then there's nothing until July. Okay, notice right there. There's this. There was the next one offered is July. There's no May and there's no June. Why I do not know. I mean, sometimes Masha, I shouldn't say that. It oftentimes happens once you get to that 3 to 4 month range. A lot of times you just have to wait for a little time to pass. And so it's quite possible, like, even next week, all of a sudden they may end up starting to write a May. But for the moment, there is no May. It just doesn't exist. So if it's a choice between the two, for the moment, I would buy the April 17th. Okay. On the other hand, if next week it doesn't pull back till next week, and then a May springs into existence, I would definitely use the May contract at that point. But at this point, there is no May contract, so that's why the April 17th. Okay, so in terms of what that trade would look like, okay, here are our price slices. Slide that over. So here's what the trade looks like. Okay, we're gonna buy the 73 strike, which is right behind the back of our demand zone here. Okay, our stop is at 73.50, so we're gonna buy the 73 strike. So we're gonna be about a buck and a half in the money. Okay, when we buy that at 74.40, okay, right now it's at 76.30. So right now the option is sitting at about 560. However, when it gets to 74.40, excuse me. 74.40, then the option is going to drop from about 555 or something premium to about 440, give or take. Okay, so that's what establishes our 0 point. So you can see at the time when I was looking at this about an hour and a half or 2 hours ago, it was around 450. So those are the numbers I'm going to use. But you can see now it's probably sitting at around 440. That's what often happens. The price of options kind of jumps around. Uh, now it's sitting at 450 again. So at any rate, that's the option we're going to buy. So there's our entry. Here's our stop at 73.50. That's projecting we would lose approximately 50 cents. And on the other hand, if we got quickly to 3 to 1, well, then that's how much we would be making, about $1.80. All right. So again, doing the same thing that we did before, if we slide over here, okay, here's what it looked like with the stock. Here's what it looks like with the buying the call. Okay. So we were going to buy the call. There's our 450. That was the premium that I just showed you. That was our 0 point. Okay. The risk on this, okay, as I just showed you, was about $50. Okay, if things didn't go right quickly, again, if it takes some time for us to lose, well, then again, we're going to lose a little more. So again, I just kind of threw an extra $25 on top of it. So he basically said, okay, we're going to lose anywhere from 50 if it takes a short amount of time to 75 if it takes a while. Let's just say within, let's say, 2 weeks. Okay, well then on a return on investment, that's approximately an 11% loss if you lose 50, and it's about a little less than a 17% loss based on that 450 if you lose about 75. Okay. On the other hand, if things go right for the trade and we get up to 77.10, which is our 3 to 1 over here, if you get to 77.10, and that's our 3 to 1, well then essentially looking at the options platform, here I just showed you this here. That was that $1.75 that I just showed you, which is right there. Okay, but that's if it happens quickly. What if it doesn't happen quickly? Well, if it doesn't happen quickly, then again I decided, well, then let's take off $25. Okay, so at that point, then our range is going to be roughly $150 win to $175 win. Okay, on the lower end of the range, you're making about 33%. And on the upper end of the range, you're making about 39%. Okay, so that's how this shakes out with respect to the underlying versus the derivative, the option. Okay, and so you can see right here, the risk on the okay, in terms of the stock, you're risking about $90 in the trade. Okay, here you're risking about 50 to $75 in the trade. Okay, and then here you can see you're making a bit more. You would make about 270. Okay, if you caught that. Okay, on the other hand, you'd be making a fair amount less, about $1.50. Of course, based on the fact that in one case, okay, you've got a $74 price point, and in the other case, you got a $4.50 price point. Well, needless to say, of course, the return on investment, of course, is huge, both on the plus side as well as the minus side. Okay, but that's how all this shakes out with respect to the option as well as the stock. So what we'll now do though is we're now going to look at the expressing the trade using the MCL micro crude oil futures. And in fact, we had actually looked at this chart the other day because I remember I was even talking about the golden cross the other day. I'll just throw that in just to refresh your memory here. Moving average 2 lines. There you go. So there's your golden cross. Okay, where we talked about the 50-period moving average moving above the 200. So that was that thing we had talked about the other day. All right. So in terms of now looking at the futures, just drop this in here. So we'll have that comparison again. Hang on 1 second. Let me just grab the other one here. Okay. So here's the deal with futures. Um, the oil futures are denominated in pennies. Okay, so this goes 688, 85, 86, 87, et cetera. Okay, with the full contract, each one is valued at $10 per penny. So if the price of oil would move a buck, okay, that would be 1,000 ticks. That would be $1,000. 100 cents, 100 pennies times $10 per penny, and that would be how much your risk would be. Okay, but of course the micro is 1/10 of that. Okay, so it's literally $1 per penny. Okay, so in this particular case, here our risk to buy one micro contract of the crude would be $100. Okay, so the buying power, if you go to the table, in any options platform. Right now, for buying crude, the margin is approximately $6,000 to $7,000. Needless to say, doing the micro, it's 1/10 of that. So in this particular case, the margin required is $600 to $700. Okay, so now looking at the whole risk reward proposition. Okay, to basically do one micro contract. Oh, got the wrong symbol there. So to buy one micro contract, um, okay, if we bought one micro and we got stopped out, well then that goes down exactly $1 from 68.85 to 67.85. So we would lose precisely $100. Okay, that $100 based on that $600 to $700 number. I think I used the $600 number for this. Um, Represents about 17% in terms of return on investment, and of course that's a loss. So that's minus 17%. On the other hand, if things go well and you get to your 3 to 1, okay, well then of course you'd make $300, and then that return on investment would be basically half. You can see from $3, making 300 off of an investment of $600. So that's a $50 50% ROI. All right. So again, if we want to compare, here are the comparisons for all three. Okay. And it's the kind of the same similar relationships of what we saw before, that the 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 option and the futures are kind of in that same general neighborhood. You'll notice, of course, again, the same way with the S&P, you will always be on a literal basis. You're always going to be making more trading the underlying, but because of the fact that there is so much more money that you have to put up, the return on investment, of course, totally outstrips it. Either utilizing futures or or options. Okay, so you're making, you can see you're making less here. Okay, or I should say, actually, you're making less with the call. On the other hand, in this particular case with the futures, you're actually making something comparable. In fact, even just a bit more. And that's why, frankly, Ryan and I are pretty enthused about trading futures, and particularly with the FTP program, where we don't even have to put up our own money. Because futures are pretty awesome. Just as an aside, when it comes time to the end of the year and tax time comes around, you actually get a better treatment also trading futures. Futures with stocks, there's the whole, long-term versus short-term capital gains. With futures, it's actually treated as 60% long-term, 40% short-term. So if you make $10,000 trading stock versus $10,000 making futures, you actually keep more of it trading futures. I don't know how that happened. I guess somebody had a good lobbyist uh, zillions of years ago when they negotiated that whole tax treatment policy. But it's kind of awesome. Not to mention the fact there's no record keeping when it comes to that. Having said that, I still love trading options. They offer numerous opportunities. So I'm a huge fan of that. But anyway, so there you go. That's your comparison. So really, just keep in mind that essentially anything that you're going to evaluate, these are the three major components, numerical components. I mean, obviously there's a million things to evaluate, but I mean, the core things that you want to consider are: what is the buying power required, which essentially represents as a proxy, what is your actual investment in the instrument? Then what is your risk? What is your reward? And then again, you can analyze it from the perspective of return on investment, ROI, or ROR, rate of return, same thing. So anyway, there you go. So what I'll do is I will clean up and share clean up these charts, and then I'll share them with you guys. I'll post them there, and then I'll also put them in the educational portal there. So there you go.
Good stuff, Mitch. Does anyone have any questions, comments? I mean, if you are at the stage of like who Abel, you're ready to go. George, you're like you can follow and stuff for me. Make it sound so simple. That shows your level of experience and everything. Mitch has that. We both do, but don't get overburdened with
the details, like that's like the learnable part, like the margin requirements and all that kind of stuff. It's almost like learning a vocabulary, but like if you can chart, you can learn all the other stuff, right? Like I mean, like the options are challenging, futures have their challenges, but if you can chart it, you can. The other stuff is very learnable in a. We can teach it to you, or you know do your own research, whatever. Um, but it's all super important, and I do think there's some. I'm going to give you a pro and con of something. I think it's great to be that I think it's helped me, and I'm sure Mitch is going to say the same thing. I think it's helped us a lot that we can trade any of those, the three major asset classes. Yeah, Forex is out there, but there's with the micros, it's not necessary anymore. Um, I think it's helped a lot in my life that I've been able to, I started making money with futures. Someone inspired me to, Mitch was doing options, and then there was a third party involved with us at a certain point that really turned me on to it. He was a psychopath, but
Don't want to go too deep.
yeah, but he was fun, but a little bit crazy, and he was an options trader, and uh really like kind of got me into the ROI. Like I was a little bit blind to it because I thought it was too complicated, and then I learned it, and it's stuck with me. I mean, it's a long time now, so but I don't think anybody would be doing anything wrong concentrating on one of them, right? Like okay, I just chart stocks for now. Okay, great. Now when it's time to execute, and you're like, okay, I've got. $1,000 in my account. Okay, great. Now we got decisions we got to make. Do you focus on doing the occasional call and put and then the occasional micro con? Then we can worry about that. But I do think it helps, and I think it helps. I will tell you, there will come times, and I probably told a couple of you this story. Like there'll be times when it helps to have these tools in your toolbox. When uh, here's one that happened 2 years ago. When Putin or when Russia invaded Ukraine, market was gapping up and down for like a good, 5 to 7 days, and I kind of found just like, and I tried telling people in the program, just sit on your hands for a little bit, but they're like, well, but we're here to trade, and I was like, okay, okay, what can I do? um, but with the equities market closing, you have a disadvantage that you have that overnight gap risk, right? And it's not gonna, it's gonna hurt you when a call or a put, but it's not gonna be like life ending. Whereas like the futures, no, they moved here and there, and you had some trades, but like no real like you're going to take your loss, you're going to take your win. Did what it was going to do. Having that really was a really good backup. And then there's just not a whole lot of quality futures. It happens to us occasionally where like it's not that you guys can't see it. It's just that sometimes there's just not a lot of quality setups, or they're so far away. You're going to be waiting. If today's Thursday and there's nothing here, it may take till Monday or Tuesday. It's going to take a little patience, but there might be something on the options or stock market that can give you a trade, because there's just so many more that are available to trade to you. So I think having both in the, not so much for you guys that have joined in November, or December or something, or right before the new year. You can kind of just follow the money for now, and get start making some, and then you can expand. But I think having these tools do help, for some of you that have been here for a little while, Abel and Joseph, and or just have the skill level where they just can take that same skill. Someone like Arthi, who's not been here that long, compared to you. I think she joined in September, maybe August, and can see everything. Then it's just packing in whatever you can, whatever you can chart, and then you're limited by cap. She's in the UK, so I don't know if she could do funded trader, but stuff like that. So this is just a lot of good opportunities here that knowing this stuff really helps. If you guys have any questions or a symbol that you want to do a comparison on, we can do that with the last of our time, or we can end early. Or Mitch, if you have anything to add of what I was talking about.
Not at all. The one thing is to keep it simple, and kind of focus, and in other words, like the first thing is, particularly those of you who are new here, just don't even worry about options. Just learn how to find supply and demand areas, and understand what a fresh level is, and if you can do a little stuff about trend. We talked about this the other day, and let me just really quickly just bring up. Hang on one second. Let me just grab something here. Hang on. And so now I am like one trade away from getting my funded account here.
Oh, nice.
But really what I wanted to show here, and again, this is like I said, one of the things that makes sense is just being able to you know, gauge trend. You know, we talked about this the other day, because what you want to basically be able to do is, you know, in a sense, make your life easy and trade with, you know, trade with what the predominant current is, right? And so I showed this tool to you the other day. Whoops. Yeah, here we go. So, like, you know, here's this at random here. Here's the US dollar. And again, you know, again, you can kind of eyeball stuff, but this tool, I find I'm using this now all the time. You know, it's like give a child a hammer and all the world's a nail. I kind of use this now all the time because it's so simple. The tool that they've given you to just kind of map this stuff out, and you're doing it all manually. But the point is, you know, you can immediately, you know, this will give you the practice to kind of do this, because essentially this kind of gives you what the big picture is. So if you look at this in the weekly chart, and then you look at this in the daily, um, you know, low, high, higher, low, lower, high. Okay, so now you know, you if this thing takes this thing out, okay, you've now kind of basically entered into a confirmed uptrend. Okay, but obviously it doesn't look like it's doing that. But the point is, you should really, when you're mapping out the charts, start drawing these swing lines on top of everything else that you're doing, because it's simple. But this will kind of train your eye to gauge trend, and you'll find that that's going to be that's going to be a big deal, because you can trade counter trend. You just want to know that you're trading counter trend. You know, and I've, you know, people that have been with us for a while have said this before. If you've ever paddled a boat, whether it's you know, a kayak or a rowboat, or you know, or whatever, or a raft, there are three conditions that you could be paddling under. You know, leaving aside whether you're in a pond and then there's no current at all. Okay, but if you're out on the water, either in a river or out on the sea or whatever it might be, there are three conditions. Of course, you could be paddling with the current, you could be paddling against the current, or really there's four conditions. You could have a cross current, and then you could have something you can't even gauge. Okay. Well, in no particular order, the prime conditions in terms of ease is paddling with the current, and then surprisingly, the next one of ease is paddling against the current. Okay. Third is the cross current, and then fourth, the most dangerous condition, is when you can't even gauge the current at all. Okay. This helps you gauge the current. Okay. So, like I said, you should definitely become proficient in this. And again, TradingView gives you that this nice tool that you can just practice this, and it's real simple. So just wanted to go through that again. But yeah, stick to mapping out charts. Don't worry about options. And don't worry about don't worry about indicators. I know I throw moving average and a Bollinger Band in there as an odds enhancer, but don't even worry about those yet. Just become proficient in, you know, kind of recognizing, let's just say, you know, if you were looking at this a while back, spread this out a little here. Okay, so if you were looking at this, and let me just get that out of here. Okay, you should, in fact, you know, at some point, relatively, you know, sooner rather than later, become proficient in looking at something like that, going, wow, there's a demand zone. Okay, and you know, this is not. And I know somebody, you know, Abel made the comment, well, you make everything look easy. I'm not suggesting it is easy at all, but eventually you'll become proficient with enough screen time. And I'm not talking about weeks and weeks and weeks of screen time, but I mean, I'm talking about put in 4 or 5 hours a week on this. You'll find that the progress that you make will become obvious. Okay, and at that, you know, at some point, you know, seeing something like that is going to basically, it's not going to be rocket science at some point.
Hey guys, and Mitch, I made the comment to somebody. I was on a someone I was interviewing with about like potentially joining our program. And he's like, "Oh, well," and I think I was like, "Oh, you know, an hour a day of work and you kind of be pretty good at this." I was putting, I was doing a lot of the wrong things and got good kind of, I don't want to say by accident, but all that hard work went into it. I was like, you'll have a structured path. And was kind of I don't want to say complaining, but a little negative on the amount of time to put in to get good at this. And I was like, well, nowhere in life would it be okay to say something's going to take you 30 minutes to an hour a day to get good at, and you would like, be like, toss your hands up. Because college is largely 4 years. Master's is largely a year or two. Doctorate, medical school. My wife's a nurse. She went to a 4 year degree, went to nursing school later. I think it's a semester, like a year and a half. I mean, like nowhere in life would it ever be okay to say, yeah, tomorrow I have to be a millionaire at this. So you guys putting in the work, it'll all pay off, especially you guys that, Joseph's done the work. Doug, you're really doing the work. Abel, you're kind of coming back and going. That's going to take a little slower. That's not an attack. Life happens. You have kids and, work and stuff like that. But luckily for us, the market is here for us, even if we take a day off, Mitch, was the market here after you went to Egypt last year?
I believe it was here when I got back. Yeah. Also, just as an aside, just in terms of what Ryan was saying, because I actually had this conversation with somebody the other day, and he was like, "Oh my God, like I had to spend like an hour and a half." And I actually said to him, I said, "Listen, I'm, here and there, I always make this comment that, the harder I have to work at a level, generally the less the less confidence I have in it. There are certain times though I will put 15 or 20 minutes into something because there is some subtlety, particularly if I'm deciding between two levels or I'm trying to figure out, hey, can I split the trade between two different things, or if I want to stage getting in or out. That's a little more advanced stuff. But nonetheless, I'll spend a half an hour on a setup. And I actually said something to somebody about that, and they were like, wow, that's a long time. I said, listen, if I spend a half an hour on a setup and I make $700 on it, that's a pretty nice rate of return. I said at the
Not too
time,
bad.
if I think that I'm above $1,400 an hour, well, maybe I'm just a shyster lawyer. No, no, no. I mean, no offense. No, no, no. There are good lawyers out there. I'm only kidding. I'm only kidding. Don't get pissy with me. No,
The other
uh,
word you used was the one I don't hear often, but I like that.
no, no, no. No. So if you spend a half an hour, so if you spend 4 or 5 hours a week on this, and I'm not talking about it even every night, but if a couple of times you cleave off 90 minutes, 2 or 3 days, or say 2 or 3 different days, and at the end of 2 months, you can kind of just look at a chart and go, okay, there's a pretty reasonable demand zone, there's a pretty reasonable supply zone. You're in business. And at that point, then, you could be, making, a few $100s here and there. That's time well spent. This is not a game. Believe me, I got enough going on. If I didn't have a vested interest in spending my time on this, I wouldn't. So just don't get too hung up on, oh, gee, it's going to take me some time. Because as Ryan said, what in life doesn't require a certain time, time investment. And yeah, there is an opportunity cost to this. Sometimes you're going to have to make a small sacrifice of something in order to fit this in. But I'll submit that it's worth it. So
uh, I
consider
second
that.
that. And I will tell you guys too. I'm gonna get off my high horse on this, but just it's in my crawl now. So like I know someone who's to my knowledge, a successful real estate investor. He looks at 100 houses before he purchases it, knocks the damn thing down, and rebuilds it. And it's like a constant process, and that's a whole lot more capital intensive. Now I know there's banks and all this stuff, but like just a lot of ways to do things. Just gotta find what's for you. And Doug, you're doing great, man. I mean, there's a lot of people who don't do the work. You're doing the work, and you're getting in a short period. I like to take a little bit of credit for that. The two of us, Mitch and I, will take a little bit of credit because I will tell you one of the things that I think held, not to speak for Mitch, but held us back. There was no us when we learn to trade. We took a course, and yeah, we had some online stuff and the occasional.
Although we didn't have online stuff when we first started. If you recall,
Yeah.
that wasn't even there when we first started.
Yeah, no. So we didn't even have, it was really us and tears, at my kitchen table. And and I'm sure Mitch has his version of that too. And then just kind of stick to it in this. So like, if we can be there for you guys, we love it. And keep it super simple. You guys that are focused on FTPs, or I know a bunch of you are, and whoever's watching the recording, your goal is to take your small account and make some money with it, and then do FTP, and then get a much bigger account. Keep doing that. You guys who are just kind of learning, George, I don't know why you're typing supply zone. Would you like to see one before we end there? Is that what you're asking for?
Wait, if that's the case, then hang on.
Yeah, we'll end on that, George, and I'm off my soapbox about the time and effort that goes into this, but yes, just the question. Supply the demand zone is when the trade is below current price. Yes. Okay. Oh, right. Supply zone is above current price. Yeah. So
So right here, you still on my screen?
yeah, got it.
Yeah. All right. So here's that example when we first started the my presentation there. So here's the SPY. Again, I'm not thrilled with this because this is really not a fresh level because there is a rally-based rally that's at the same level before. But I gave you the caveat about that. But leaving that aside, forgetting that's there, we can out of sight, out of mind there. Okay. We have a rally base drop there. Here's current price. That's the other thing. If you notice in my charts, and again, I'm not suggesting that anybody don't make your, don't, because I know somebody, I remember a couple of years ago, we had somebody with us and he would put up his charts and I couldn't tell until I saw what it was, whether they were my charts or his, because he
Oh yeah.
literally copied every style, every color, every line thickness, everything, every font, everything in my charts. The only reason I knew it wasn't his because he would mix up supply and demand zones. I'm like, well, I know I didn't do that. No, no, no. So the point is, but you should make these your own. But having said that, um, you should more or less emulate certain things that Ryan and I do, particularly here. Okay, if you notice right here, I have always, and I think most of you do have this here, okay, but I have in here, this is always where current price is. This way I always know, exactly. I mean, of course, you got that there, but have a line that just floats around in your chart always where current price is. So this way you know, okay, where your eye path is, okay, where you start, where you go from there. So if you're back here, okay, well, I'm not looking for some, because particularly once you go way, if let's just say hypothetically, you had to go way back in time to find, let's say, supply. Okay, this way you'll always know. I always have to look above here, and that you won't end up not looking in the wrong direction. So I always find that helpful. So, but anyway, so here's current price. There's your supply. That's a supply zone. Okay. On the other hand, if we were looking for demand here, um, let's say right here, I was, talking about using this as a potential target earlier. I don't necessarily know that this is the greatest demand zone, but there is a rally base rally there. That's a demand that's a, let's say an iffy demand zone there. Okay. But that's below current price. Okay. And then at that point, then, okay, you go long out of so at that point, this is where you execute a bullish trade. And here is where you would execute a bearish trade. Okay, so you're looking to express a bullish trade here. So that's the plus S to what I talked about before, buying the stock or buying a call. Okay, up here you would be shorting a stock or buying a put. Those are your two most simple ways of doing those two trades. So anyway, that's your deal. In fact, we've posted these before. I can, Ryan, somewhere. Somewhere in the portal there should be all those slides that I put together, right? With
Yeah, she posts them in the secondary. We should actually show people on Tuesday, maybe just like where all that extra stuff is, and then we'll
yeah,
reorganize it one day. We'll take it an afternoon and we'll put slice and dice that a little bit. But
yeah. So on Tuesday, maybe you can just show everybody where those are again. So in fact, maybe
yeah.
even just post a link to it. Okay. All righty, folks. Thank you.
All right. I'm sorry, Doug. What was that? I don't understand. Touch that current price again, Mitch. What? I didn't know what he's talking about.
Oh,
Oh, that
well,
pink thing?
okay.
Yeah.
All right. So in most platforms, um, let me just see if I can find it. Let me see if I can find a trading view. I really do. I'm not that familiar. So they have indicators here. Hang on one second. So if we go to technicals, let me just see, is there something either a line or price, current? You'll have to find, I don't know where, I don't know where it would be. I don't know what they would call it here. Like in trading, trade station, they call it line at price. Um, oh, price target. All right, somewhere in here, I just don't know where. But there's got to be something. Let me just see here. Because right here, this is it right there. I mean, I don't have it up. Hang on. Oh, let me. Oh, you know what? Hang on a second. I just realized something. Hang on. Status line. Just wanted to see. How do you make that thicker? All right. So what do they call this? Oh, maybe it's called status line. Add alert. Yeah, I don't know. We'll have to find it out. But the bottom line is that there's that little thin line. I just never really, I really should make it thicker there. But anyway, it's in there. So I don't know what they call this, but you should make sure you have that in your chart there. So we'll figure out what it's called and we'll post it.
All right, guys. I will see you, George. I'll answer some of that stuff privately. It's not important or germane to like what we do in a day. But I will see you guys on Tuesday. Hope this helps. Any questions? You know where to post them. Take care, guys.